Hey, Dave, thanks for having me.
Hey, thanks for being here. And let's start off with what the Fed is doing. And it seems like they might be stuck because, they've been telling us how they're going to be raising interest rates. And they said, oh, maybe we're not going to be raising interest rates. We know they're unwinding their balance sheet. Now, what is happening with the Fed? Why are they going back and forth? Are they stuck?
It's a very unique situation, Dave, because what happens is in the 70s, when they had to raise rates in order to curb inflation, the U.S. was the larger creditor nation in the world. Now it's the largest debtor nation in history. So you can't keep just raising rates because, like I told you in the last interview we did, the Fed is now at odds with the federal government because they have different agendas. Trump lowered taxes in order to induce the spending economy, in order to induce corporations to make more expenditures, and in order to jolt the economy forward, get full employment, get more people back participating in the workforce, and just have a booming small business America, which has always been the backbone of this country. On the flip side, when you lower taxes, you get less revenue coming into the federal government, and they need to auction more debt. And obviously, if the Fed raises rates, then that debt and the borrowing costs are getting bigger and bigger. So you got the federal government doing one thing, the Fed doing another, and they have to balance it out. And obviously, the Fed being kind of independent from the federal government with their policies, that is something that is very important. So they will not raise rates to a level that you saw in 1980. That's simply not plausible these days. So they need to kind of figure out where they can take the Fed's funds rate with regards to not only the U.S. federal government and their borrowing costs, but it's also going to affect corporation borrowing and how banks are going to be able to send back the excess reserves that they got in the days of the QE, and how developing nations, emerging markets, are now in a dollar shortage, so they're going under lots of problems there. So it's a very delicate game, and I don't think they're stuck is the right word yet. They are having a hard time managing a tightening period, which is in the last 47 years, every tightening period has resulted in a recession. So we are in a situation where a recession is almost guaranteed because it happened every time they tightened and shrunk their balance sheets and raised rates in the past 47 years. But it remains to be seen what will happen this time. So it's kind of funny. If I give you an analogy, I was just in the Grand Cayman Islands, very small. A very small island, but it has a microclimate. So you can be on one beach having a good time, sun is out, and then 5 minutes from you, you can see a huge cloud and pouring rain. So things can happen in a very geographically tight area, and very uncorrelated things can happen. But once a year, 1 month out of the year, they have a hurricane or a storm that blows over the entire island. And so, if you're a resident there, you're not preparing for a storm 11 months out of the year. You enjoy the weather, the great weather, and you find your spot, you find your sector, you find your niche. If I go back to the economy, you find what is working right now, what is trending, and you invest in it. But 1 month out of the year, you better duck. And so when you build a portfolio right now, or you manage your portfolio, you shouldn't prepare just for a storm that's a year away or a year and a half away. You should enjoy what's going on in the economy right now, and there are places to make money. But you should always remember that when the Fed raises rates, the Fed's fund rate, which is the overnight lending rate for banks, is at 1.75%. The 10-year bond is around 3% right now. Historically, when the Fed fund rate it catches up to the 10-year bond, to the 10-year yield, you got to watch that number, because when they catch up, it's historically has always caused a recession, a crisis, and a market correction. Whether it be 10%, 15, 20, 25%, it remains to be seen. Obviously, there's many more elements involved, but it always happens. Now, if they keep raising at 25 basis points, then the gap is about 1.25 percentage right now. So you got about 5 rate hikes to go, all things being equal to what's going on right now. So there is like a year and a half before the true recession imminency becomes a problem. So we got all of these different various things going on, and the Fed is trying to manage this. And obviously, the wild card is whether or not the U.S. consumer will start spending the tax benefits that it received, and that will kind of expedite inflation. And if that happens, then the Fed will really be in trouble. They will need to get creative with what they do. So it's a very unique time for them. And as Ray Dalio alluded to a number of times, it's the most dangerous time because they're almost out of tools and they cannot keep raising rates indefinitely, like to 20% like they did in the 1980s, because America just cannot stand that type of environment. It's simply unplausible. Now, as you can see, both China and Japan understand that this is the problem. And if you want to get Wealth Research Group's take on this, then in 2010, both China and Japan stopped raising the debt levels that they hold of U.S. Treasuries. So since 2010 up until today, if you look at a chart of how much debt China and Japan owned of U.S. Treasuries, it's flattened out. Whereas in the 2000s, they were buying a lot of U.S. debt. So somebody needed to fill that gap, and that was the real reason for QE, to help the U.S. Support its ongoing deficit, because China and Japan, the biggest nations to buy the debt, were not increasing the debt load. China is not as dependent on U.S. consumerism as it was, back 15, 20 years ago. It's now the 45th cheapest country to manufacture it. So imagine there's 44 countries that manufacturers like Nike, Gap, all the big ones can go to and get cheaper labor. Chinese is moving more into a service economy, more into where the U.S. was 50 years ago, where they need a lot of products done for them, manufacturing done for them. They have a bigger middle class right now, and they're transitioning into a more robust economy. So they are not as dependent as before on U.S. They do not need this codependency where they buy the debt and Americans buy their products. It's much more involved right now, and the U.S. is going to lose out on this, and this eventually will cause the de-dollarization and the loss of the currency, the reserve currency role. And I could tell you, kind of where we see this happening. But just to wrap up the answer here, if you want to really stay on top of this, watch where the 10-year yield is, where the Fed funds rate is, and if it catches up to it, make sure you're ready. And we always talk about this at the Wealth Research Group letter. We update on this all the time and how to adjust.
Now, you mentioned China with their manufacturing. Now, they're not really dependent, like you said, on the United States, but they're also setting up the Belt and Road, which will allow them to receive manufactured goods or ship out manufactured goods through this Belt and Road system. I mean, how is this going to benefit them in the long run? Is this really going to, make them shoot, much higher than they are today in regards to the economy?
The Chinese will have the largest GDP on the planet by 2025, surpassing that of the U.S. So they will have much more political capital with emerging markets and with the bigger developed nations, with the EU, with everyone else. So in about 7 years, you will see a major detraction in U.S. middle class participation and how the world works and how their president can keep making demands and maneuvering soldiers, capital, people, everything else around the world. China will become more important than the U.S., by 2025. That's one thing. That's the GDP part. So the incentive to work with China will be much more than the incentive to work with the U.S. in about 7 years. 10 years later, so by 2035, the Chinese will spend more on military and defense spending than the U.S. So we are going to be in another Cold War environment from here on in the next 17 years, where both countries are going to go into artificial intelligence and advanced machine learning, supercomputers, quant computing, other type of warfare, etc. And by 2035, the Chinese will surpass the U.S. And once they do that, that will probably be the end of the dollar as a reserve currency as we know it. So major changes coming to the U.S. And that's why Wealth Research Group sees the next 10 years, so between 2030 and between 2030, as America's best decade in the coming century. After that, the name the Asian century, which was dubbed in 2000 for this 21st century, will actually be appropriate because China will dictate the future, obviously along with India and other emerging countries that are from the Far East, and the U.S. will play a lesser role. Just like the U.K. still has a big role in the world economy, but a much lesser role than when they had the reserve currency. So I hope that answers your question, but if you have a follow-up on that, I'll be glad to take it.
So during this period that you're talking about where the U.S. is going to be seeing this time, I mean, is this just smooth sailing, or are we going to see inflation, or are we going to see recessions? I mean, is everything just going to go perfectly smooth throughout this period?
Well, obviously, with 6 out of every 10 currencies in the world being the U.S. dollar, and only about 1 in every 100 being the Chinese yuan or the RMB, you got to imagine China has to become the world's reserve currency, or more important on the global scene by bridging this gap. So the U.S. dollar is 60 times more popular with nations than the Chinese yuan right now. So it's definitely not going to be smooth sailing. And like I said, it's going to be an arm race with regards to arming their militaries with new type of technologies, cyber war, a lot of new things that are going to happen in this race for global supremacy. Definitely not smooth sailing. If you're looking just at the U.S., and I've wrote a lot about this at wealthresearchgroup.com/portfolio, which is my personal allocation model for 2018 and beyond, and how I prepare for this, and also at wealthresearchgroup.com/crash, which is an entire PDF report dedicated to how to prepare and anticipate and then capitalize on the next market crash. The U.S. is definitely going to have trouble, just as any other country that had the reserve currency role had before. The Netherlands had that, the Portuguese, the Spaniards, the French, the UK. If you remember, the UK had power outages in the 70s when they lost, 20 years after they lost their reserve currency, because they had so many new things to deal with. When you can just print money and the rest of the world basically accepts it, that is a huge advantage to your economy. You can run these massive deficits, hit 21 trillion in national deficits and national debt, and run $1 billion deficit economy yearly, and the rest of the world will suck up your debt because you're the reserve currency. So it's a very interconnected system. The U.S. will not be able to do what it's doing right now and still pay the retirees their Social Security, their Medicaid, and their Medicare, along with paying about 40 million Americans with food stamps. And basically, 1 out of every 2 Americans, on average, gets some sort of a subsidy from the United States government. 100 million Americans out of 330 million Americans are not participating in the workforce. No other country has these luxuries, where a third of the country is just sitting and enjoying retirement. Big things are coming. For the U.S. Consumer, for savers, for investors, it's going to be a major change. And whether or not it'll be smooth, I don't think it'll be smooth. It's too big of an economy and too big of a transition to be smooth. So then you have the opposite side, Dave. So I talked about the negatives, the problems, the all the challenges that are coming. On the flip side, the U.S. economy is much more robust than 10 years ago. It has record profits for corporations. Obviously, it's creating a huge wealth gap between the people who enjoyed the QE systems and enjoyed the ZIRP, the zero interest rate policies. And so you've got an economy where it's going to be, in about 7 years, it's going to be 10% rich, 90% is the rest, just like the rest of the world, with virtually no middle class. Now, demographically, what's coming in, what's coming down the pipe is this: about every 10 seconds, a boomer celebrates his 65th birthday. So they're retiring, they're getting out of the workforce, and they're leaving high-paying jobs, leaving jobs that they stayed with for 40 years, and you got the millennials sucking that vacuum. So you got a wealth transfer from retirees to millennials. They're going to start enjoying better salaries, more developed jobs, more skilled labor, a lot of new jobs in artificial intelligence and in blockchain technology. And the cannabis sector is going to be legalized, maybe even federally legalized, but obviously state legalized with half the country still to go. And then you got much more interesting new professions that are going to come down in the next 10 years. And there's a lot of openings. So they are going to fill those gaps once they become trained enough and experienced enough. In the meantime, corporations are paying overtime. They're keeping people in the workforce because they cannot find skilled labor. So that's the good part. And the millennials are really the people who do not have homes right now, do not have cars. So they're going to be the engine of the economy between 2020 and 2030 as they hit their peak economic years. It's going to be very, very interesting to see whether or not they're going to take their savings and invest them in the stock market as the boomers have done. Because not every generation in the 20th century in America loved the stock market. We saw between 1964 and 1980, so about 16 years, we saw an entire generation who stayed in cash or bought bonds. They didn't invest in the stock market, the previous generation to the boomers. And it seems like millennials are kind of the same way. So if boomers are going to liquidate their holdings in the stock market in order to fund their retirements, then you're either going to see Asian money coming in to buy U.S. corporations, or you're going to see much lower prices for U.S. equities, basically a sideways market or even a bear market in the next few years. The economy itself will do pretty well, save for times of recessions and short-term recessions, etc., because there's going to be a lot of demand, and with the world becoming very very productive overall, and Asia becoming a much more robust economy, the prices of goods, the prices of raw materials will increase. Now, remember, when commodity prices increase, that doesn't mean that there's going to be a lot of inflation when it comes to the end product. If you buy a loaf of bread for about $1.50, only 7 cents of it is the cost of the wheat. So even if the cost of wheat doubles, then you're not going to see a loaf of bread double as well. What does impact prices more than anything else is labor costs. So if you're going to see wages continuing to rise like they are right now, you are going to see much higher levels of inflation throughout the economy. And I believe that with the tariffs that Trump has put in place, you are going to see wages increasing. You are going to see raw materials increasing. Whether or not you're going to see the price of precious metals rise substantially or not, I can talk about that in like a separate question. But overall, I see a 1970s problem with regards to higher inflation, but it's more going to look like the 2000s, where you had all economies, global economy, growing at a rapid rate, and it did have its slowdowns, etc. But you are going to see pretty much a robust economy, ending with with the stock market bubble down the road. So yeah, it's not going to be smooth sailing, but it looks like if a systematic problem such as what happened in 2008 can be avoided, then it's probably going to be a very good decade overall, with the big question mark being how will America be able to avoid the problems that have to do with de-dollarization, which we are seeing for sure in the next decade.
Oh, I was going to ask you the question about gold. I mean, I was going to ask you, where do you see gold going? What is gold going to do during this period of time? Because right now it's like in the 1300s or so, around that area. Do you see a huge breakout for gold during this period?
First of all, always when I do these interviews, I get a lot of emails and questions regarding the price of gold or the price of silver, and I want to make sure people understand my position with this. So first of all, if you want to get really educated on gold and see a complete manual, we created the lengthiest manual that I'm aware of with regards to gold investments, and you can go to wealthresearchgroup.com/gold playbook /gold playbook and download the lengthiest manual that we've ever put together. We aggregated it through 20 years of investing, and I think that's a great weekend read for everyone. The way that I have structured my portfolio, starting the age of 16 when I started investing, and in the past 18 years, is I have this start over fund. The start over fund is if everything goes belly up, the world becomes a very problematic place, the apocalypse type scenario, then first of all, I have cash in 5 major currencies outside the banking system, in duffel bags for about 1 year's worth of living expenses. If there's bank discontinuations, bank holidays, market problems, all that kind of stuff, then that's one thing. On top of that, I took my lifestyle burn rate, my monthly lifestyle burn rate. Let's say it's $10K a month, $10,000. You multiply it by 24. You take that money and you convert that fiat into precious metals in physical form, either gold or silver or both. Personally, I have 80-20, 80% gold, 20% in silver. And you either, you spread across whether or not it's a few continents, a few storages, and your main residence, whatever you want to do, just figure that out and be done with it. And that is your physical gold silver allocation, and you just never worry about it again because you got 2 years worth of fiat burning expenses in gold and silver. Alternatively, you can take about 4 to 7% of your net worth and do the same thing. I like this because then I have in my head that that's how much I have set aside, and obviously their purchasing power increases in catastrophe situations or in high inflation situations, so it's even more than 2 years worth of living expenses. And then you do not care about the price of gold on a day-to-day basis because you're protected. You know how much you have set aside. If you want to bank on the price appreciation of gold, or even more so on silver, then physical precious metals is not where the game is at. Right now, if you look at the cover ratio, meaning how much ounces of gold cover the U.S. currency supply, it's about 7%. So if you take 1,300 and time it by 14, that is how much the price should be if every dollar was backed by gold. So that's about $15,000 per ounce. That's the rosy scenario, a 14-fold return. If they back the entire currency supply, which they obviously won't. A more classical gold standard is about 20%, which is 3 times the price that it is right now. And obviously you can go to 40%, which is about 6 times the price that it is right now. But these are like rosy scenarios. Whether or not they will happen, we do not know. What we do know is that in order to capitalize on the price appreciation of gold and silver, the best way to do it is in a more leveraged way, either with the mining shares at the right times, or with a more sophisticated short, long strategies using some ETFs. So it just depends what do you want, and what's your goal. If your goal is to protect yourself, then you need to buy as much gold and silver as you can afford, but don't go overboard, because, as I said, you're buying insurance, and you do not need to to buy too many policies in life, right? Nobody has 20 life insurances. One is sufficient. So no need to go overboard there. You just need a sufficient amount. And I think 2 years worth of living expenses is a very comfortable position to be in, or about 7% of your net worth is also good, pertaining how much your net worth is. And then on the flip side, if you're looking to speculate or capitalize on price movements, the mining shares have historically been the right place to be at the right time, if you can really time that right, because they are very levered up or leveraged to the price of the underlying commodity. They can move 1,000%, where gold moves 15%. So it's important to see this. Overall trend for both gold and silver, the overall trend is up. They are in a bull market. If you look at previous bull markets, you can see that when they start, they were much more aggressive. So, Dave, if you look at the previous 5 bull markets in precious metals, the first 3 years, which we're in right now, because the bull market in gold started in December of 2015 when it bottomed at $1,053 per ounce, and it's now about 22% higher. So the first 3 years were much more aggressive. In other words, this is a very tame, calm bull market. And that's why the mining shares haven't participated, because the market is not convinced that this is a bull market. What will need to happen is the price of gold and silver will need to catch up to its historical precedence. And our price projection for gold is 1704 per ounce. Okay, 1700, about 1700 per ounce in about 2 to 3 years. And that is a major move, a $400 move in the price of gold, and about $30 silver. So this is in the next 2-3 years, as the economy gets more heated up, and then the looming recession causes more demand for precious metals. Remember that precious metals investing right now, the physical gold bars and bullion, if you call the dealers, you'll see that they are hurting right now. Dealers are not enjoying any investor appetite, and yet you see the price is very steady, and that's because of government buying, and that's because the people that are holding their precious metals are not selling it that easily. So the overall trend is definitely a bull market, and even better, it's going to catch up to its historical averages and going to rise much further. There has never been a bull market for gold and silver that has ended with a 22% return. The lowest we've seen is about 70%. And so if you start at 1,053 and you add 70% to that, that's 1,700. That's why this is the conservative side for the end of this cycle. So I believe exciting things are coming, and that's something that we are going to cover a lot at the Wealth Research Newsletter. In fact, I'm so bullish on silver right now that I even tried to get a group to buy out a number of these publicly traded companies, which I believe are trading lower than their liquidation costs, and they have more cash in the bank than their market cap. So they're so cheap right now that they're even trading at a situation where you have more cash than the entire market cap of the company.
Now, you mentioned de-dollarization, and, we've been seeing and watching China and Russia dealing outside the dollar. India said that they're going to be purchasing Iran's oil outside the dollar. Africa is saying that they rather deal in the yuan. I mean, is this part of the transition, moving away from the dollar and moving into the yuan? Do you think the yuan is going to be the reserve currency, or do you think we're going to be transitioning into something different?
I do not know the answer to the second part of the question, meaning whether or not the yuan is going to be the reserve currency or not. It remains to be seen. Obviously, China is going to be the most important country in the world in about 18 years, like I said. But whether or not the world will trust the Chinese government as it did the U.S. government remains to be seen. The Chinese will have more control over which currency or what system will play out next. And yes, de-dollarization has started, and that is why Trump is trying to ramp up domestic manufacturing and domestic economies and industries, because he knows that the days of printing debt, buying goods in exchange for debt are going to be over. And the U.S. needs to be very independent of the rest of the world if it wants to sustain its standard of living. That's why you see the oil industry in the U.S. so robust right now. They are trying to make sure that when they can't send insane amount of debts overseas in exchange for barrels of oil, that they have enough to run the economy on and even become an exporter of oil, which is what the U.S. will be in about 2 years. So what they've done with the oil renaissance is what they're going to need to do with other industries as well. Obviously, the U.S. will never be able to compete on labor with other countries, but it can compete on quality, which is what they will continue to do.
So do you think cryptocurrencies will be part of this transition? Do you think there's any place for cryptocurrencies? Do you think maybe on a lower level, countries will use cryptocurrencies? I know Russia, China, they're looking at it, and many other countries are looking at it. What do you think about that?
If countries will use it, they will use their own issued cryptocurrencies on their own issued or their own created blockchains. They will not use, decentralized blockchains or private blockchains of other countries. They will privatize their own blockchain and put their currency on it. In other words, they will build a blockchain for their own currency, and it will be no different than the fiat currencies you have today, and except for the fact that instead of being on a database that is centralized, it will be on a blockchain. But you as the average person will not feel the difference. Whether or not cryptocurrencies will compete with fiat currencies or blockchain issued fiat currencies, that is the big question that remains to be seen, and we'll see what happens. But I don't think that the more developed cryptocurrencies are going away. There's no reason for Bitcoin or for Litecoin, Monero, the Dash, the other big ones that are aiming to be mediums of exchange and robust network effects. They're not going to go away. They're going to they have their value proposition. They're there for people who are disgusted with government money, with the fact that the government basically owns the currency, and that you can find yourself one day in a situation where your bank is belly up. So they have their value proposition. They're going to stay there. What I am very interested in seeing is how the G20 meetings this summer build the regulatory framework for cryptocurrencies in the future. Now, remember, if you scroll down the list of 1,500 crypto assets that are trading right now, more than 1,400 of them are not aiming to be currencies. So the name cryptocurrency is not suitable anymore to this group of assets. They have other use cases that they're trying to fill. The currency part of it is very little right now. So, Dave, if what do you want out of the currency? You want it to be stable. You want it to be an easy medium of exchange, comfortable to use, have a limited supply, right? And then you also want it to be fast, international, meaning it can cross borders real fast and for cheap fees. And a lot of the cryptocurrencies, the big ones, can meet those demands. Now, what has become very apparent is the fact that Bitcoin only has 21 million units. It does make Bitcoin limited, but it doesn't deter competition from opening their own currencies. So there's an infinite amount of projects that can start. So that limited supply part is only good if Bitcoin becomes the only game in town. But if it has viable competitors, then the big reason to use a cryptocurrency is because you want to move money fast across the world very anonymously and be done with it. The speculative bubble is over. The bubble that the run up that took cryptocurrencies to elevated levels in 2017 is over. Remember, if you buy a cryptocurrency in order to sell it to somebody else for a bigger price, that is pure speculation. Now, pure speculation has its benefits. God knows, Wealth Research Group covered Ethereum at $12, and it went over 1,000 in 1 year. So people made 90 times their money. So it's an amazing place to be in when you're in the right place at the right time with these speculative manias. But going forward, cryptocurrencies will obviously have a better experience with their users if they stay stable, because the bid from new buyers will not continue to go up. It has its intrinsic value, and where it will start to stabilize and do what it's meant to be, which is a medium of exchange and to an extent a store of value, a digital store of value.
Now, you mentioned cryptocurrency and how you were looking at Ethereum, and you were looking at the investment of $12, and it went up to 1,000. And I've been interviewing you going back some time now, and I've noticed that with Wealth Research Group, you focused on different areas throughout the years. I mean, if we go back to 2016 when the Fed was raising their interest rate, you focused on precious metals. And if I remember correctly, you focused on 12 different companies during that period of time, and they doubled. In 2017, just like you mentioned, you focused on cryptocurrency, and you saw huge gains. In 2018, what are you looking at now?
Well, 2018 is definitely going to be the year where artificial intelligence rises out of its infancy and starts to disrupt the mainstream economy. Just like in the 1990s, the personal computers revolution brought about the birth of Microsoft as one of the most profitable companies ever. If you bought the day it IPO'd and held on until today, you're a multi-millionaire. The same thing with Google. Google IPO'd in 2005 after being a private company for about 6 years and revolutionized search engines. So the need for researching everything online and having access to knowledge was what Google commercialized, because they started making billions upon billions in ad revenue, because everyone went and researched for anything that has to do with consumerism. Now, the big next thing is machine learning, supercomputers, and how they make your life efficient. It starts from Google Maps and getting better commute times to work. This is machine learning, understanding traffic patterns, and this is only the beginning. Artificial intelligence will be able to tell you how you can sleep better, what time is better for your body to get up, what time is better for it to sleep. It will be able to help people with their health issues with nutrition. It will tell you if your body needs more fruit, more vegetables, more carbs, more fat, etc. Then you're talking bigger things like autonomous cars, self-driving planes. You're talking about machine learning that will help you find the best opportunities in investing, in real estate, in everything else. These are computers that think, and therefore they have a huge part in our future. And the first companies that will be able to commercialize solutions, softwares, applications with regards to this new industry will be the next Microsoft and the next Google. And I'll tell you what, in the last 180 days, I have researched, for the past 6 months, I've researched a company that is that went public on the 13th of June. So I'm talking just a few days ago, and it's called Global Live Technologies. It's founded by Anthony Lacovera, who put $15 million in cash and assets into this deal himself. And this guy was CEO of the Year in Canada a number of times. He was one of the top influencers in Toronto, voted a number of times. And he's not only a wealthy man, but same as Buffett, doesn't take more than a symbolic CEO salary, which will, it's peanuts for him. This is how Anthony has built this company. He owns 40% of the stock, 70% of the voting control, and he wants to make this the next Google. He wants to make this the Google of artificial intelligence. It's just started trading. We created a fully vetted management proven report on this company at wealthresearchgroup.com/live. It is so early stage right now that it's only trading in Canada. It will have a U.S. symbol in a few days. But this, Dave, this is the only time that I have concentrated my entire speculative part of my portfolio in one company. That is how confident I am that this guy will become personally a 20 billionaire off of this, and that this is the biggest opportunity that we're going to see in 2018. And with their vision of what they want to do, coupled with the fact that they're using blockchain and decentralization in order to leverage artificial intelligence, and they are using what's called a joint venture model in order to accelerate their market share, the sky's the limit. I've never been more confident about any company that I've invested a six-figure sum in. So it's something that I am very excited that I found out when it was still private, did a lot of research due diligence on, and Wealth Research Group is one of the first newsletters on the planet to cover this company, and we'll stay with it for years.
Now, when you say that they're going to integrate this with blockchain, what are they planning to do?
Well, if you look at the most immediate use cases for blockchain technology coupled with artificial intelligence, healthcare is a big issue, supply management. So people will and companies want to know exactly where all the components are on a global basis. Think of companies like Procter & Gamble. They want to know in 70 countries or 80 countries how their shampoo sales are going. It can be as easy or as niched as knowing in Peru what shelf is the Procter & Gamble shampoo standing on. If it's on the third shelf and they want it on the fourth shelf, then the HQ can know all of that by using artificial intelligence and blockchain technology. They can show their shareholders much more transparency with how their operation works. This goes to fleets of cars. This goes to international expediters like UPS knowing exactly where your mail is. About $7 billion a year worth of mail is lost only by the United States Postal Service. So you heard that right. It's an insane amount. With computer learning and artificial intelligence and the blockchain, you couple this in supply management, you're going to know where the tomatoes in your ketchup were grown. You're going to know everything. More transparency, better consumerism, more protection for consumers to know where their products that they're buying are coming from. And this is going to help to drive down prices. It's going to help to create a more robust economy. You're talking use cases in banking and using this to create better loans. So if you go and you apply for a mortgage right now, most of the people get the same type of interest rates. Computer learning would know how much your disposable income is, what's your situation. It will help to fit a mortgage that is a win-win for the bank or the lending institution and yourself. Affordable to you, profitable for them, with less risk for a default. So a situation like 2008, for example, could have been avoided because the risks would have been more transparent on a decentralized system. The list goes on and on. Whether you talk about the exchanges, whether you talk about market hours for the stock market being open 24/7, the sky's the limit. We live in a very exciting times, and obviously, just think about the amount of money lost every year in the biggest economies in the world, so Europe, Japan, and the United States, with people being on sick leave or vacation time or being in traffic on their way to work, or just think about people in their 50s and 60s who are less motivated by their careers and they're less productive. A lot of these people can be, could use the help of computers that make rational decisions instead of emotional decisions, don't have peaks and troughs when it comes to their motivation, the world is going to become much more efficient. People are going to become much more efficient, and it's going to disrupt major industries. It's going to happen with or without you and I. So we need to adapt to it instead of fight it or talk about whether or not it's good or bad, because it doesn't help our pockets. We need to either bank on this in terms of our careers or in terms of our portfolios. And I am certainly banking on this in terms of my personal portfolio. And I am very excited that before the major institutions have a chance to look at this company, I was able to find it when it was still private and give our readers a chance to look at it since day one.
Lior, thank you very much for being on the X22 Report Spotlight. Once again, how can people see your work?
Best way is to, obviously, all of our top-notch, highest priority reports and information are in the newsletter, which goes out about 3 times a week. And we cover many topics, macroeconomics plus specific opportunities. That's the letter. It is right now free, and we aim to keep it free forever. And then on the flip side, if you hit the website and you want to take us for sort of a test drive, you can go to the Special Reports tab. It's an aggregated wealth library with many PDF reports on many subjects, starting from the investment principles